So I wanted to also talk about one potential setup, right? Maybe this isn't the time to do it. And again, I'm going to go back and talk about or mention that the reason I don't think it's a great time to do it right now is because the range of the market movement, right? If we look at the highs to the lows on a day-to-day basis, intraday movement is increasing. The markets are becoming a little bit more volatile. I don't think it's a great time to put on trades that have a defined range in which we're going to make a profit. But if you look at the shape of this risk graph, right, and we wanted to do a trade that looks similar, right, with maybe some additional benefit. And maybe we'll go out and do a 50-point wide put credit spread. And if we are looking, let's see what is available. We don't have to go too far because, again, if the trade goes down about 4 or 5%, we're going to cut it. So we don't have to go, 5 sigma out of the money to look for a put credit spread. We want to collect a decent premium, right? This is a 50 wide that's currently going for about $6.30. Okay, great. Now, normally, right, I would look at possibly setting up a put debit spread closer at the money, right? Maybe something like this. And I am giving up some of the potential reward from this put credit spread by paying for this put debit spread. And I have the best of both worlds at expiration inside of this put debit spread and the put credit spread. You can see that, right? That's the bear trap profit. But what if instead of buying a debit spread, what if I went maybe slightly out of the money and sold a credit spread instead, right? Not giving me this fat bear trap zone, but instead I can have a more normal profit zone, and that's going to actually give me a little bit more participation to the upside. So maybe I'll go out and look at something like a selling a 6,900 call. Let's start with maybe a 10 wide, and we'll see where we end up. Right? So here we are, right? We have this would be considered, or this would be called, an iron condor, right? We have a call credit spread and we have a put credit spread. Putting two together, it's an iron condor. It's not a typical iron condor where the widths of these two spreads are equal. This is an unbalanced iron condor. We're shifting risk from upside to the downside. We have more risk to the downside than we do to the upside. If you wanted to, think about like a jade lizard, right? They're all very similar structures, except this is a defined risk trade. So what do we have here? We have a trade that's currently going for about $9 credit, which means that if we are inside of 6,250 and 6,900 over the next 42 days, the max potential profit here is the credit collected, which is currently about $9.10 or $9.20. Our risk or margin in this trade, right, this is a 50 wide, which is it's a risk of $5,000, but that risk gets reduced by the amount of credit that we're collecting. So if we're collecting $9, our risk is 50 points or $5,000. We collect $900 credit. Our margin gets reduced from $5,000 to about $4,100. Right? So $4,100 worth of risk, $900 of potential profit. We have small upside risk, right? So there is some risk to the upside. It's not all that great. We don't have a big fat bear trap that's kind of hard to guess without getting lucky if we catch the price inside the trap. But we have a higher potential return on risk, right, in a wider range. So instead of concentrating a bonus profit or the bear trap profit in a smaller range, but making that return closer to 30%, we're just going to shift some of that potential bear trap profit from being concentrated somewhere between, maybe 65.50 or 65.40, right? We shift that potential profit and it's going to get reduced, right? Because we have a much wider range to make a profit in. And this is a defined risk trade in a defined range for profit, right? We make a profit between the break-evens are at 62.40 and about 69.09, right? If we add the amount of credit to the short strike on the call credit spread, that pushes out our break-even to about 69.09. Right, so we have about 4% room to the upside. And remember, I mentioned that I'm going to get out of this trade if we're down, whether I'm setting up an OG bear trap or I'm setting up this trade. If the market goes down and I'm down about $500 or $600, I'm out. Right? If the market goes down 4% and I was in a bear trap, I have to close out this position. If I put this trade on, if the market goes down 4%, I'm out, right? So I'm going to get out of this trade at a stop loss at about the same price level. So the risk hasn't really changed a whole lot. My reward changed. Instead of capturing a potentially higher reward in a much smaller range in the bear trap, I shifted this range, right? I spread this range out a little bit, giving myself a wider range for a profit, and I reduced my profit potential just a little bit. I know this probably sounds like a lot, but if you really stop to think about this, right, this kind of makes sense, or at least it makes sense to me. Look, I'm not saying that I found a holy grail. This is it, right? The search is over, guys. We found it. Right? But we're just putting a couple of pieces together. We're putting two spreads together just to see what does this risk graph look like. Again, am I going to run out and put this on today? Probably not. Why? Remember I said the ranges right now are still increasing. So I'm thinking that there may be more volatility ahead. And if we get more volatility ahead, any potential profit that we're going to get from the theta component will be replaced with the negative vega component, right? Because out of the money premium, the time premium is made of two components, right? There's time and then there's volatility. The time we cannot stop, and volatility can go up and it could go down. When the time continues to tick and volatility is contracting, they're both working for us. So we get a nice, big, juicy theta decay. When volatility is rising and the time continues to tick, right? The time is working for us, but volatility isn't. So they kind of offset each other. So if the range is expanding and more volatility is coming into the market, right? If I put this trade on and volatility continues to rise, I can look at this trade a week later, even if nothing much has changed as far as price goes, this trade may not be wildly profitable because all of the theta was replaced with IV and I'm back to where I started. So I'm not saying that, today is a terrible time or today is a great time. You just kind of want to take all of the information that is available to us and think for yourself. Look, if you want to do a starter trade at this point, and then maybe your size is 5 lot, you do one today, you add more, next week or whatever the case may be, right? There's many different ways to scale in and out of this trade, right? But we're just talking about the idea for this trade. And if you wanted to compare whoever iPhone user is, right? The question is from one of our members: does the T plus zero line behave more or less like the OG bear trap? And that is a great question, right? Because a lot of times we get so fixated thinking about the risk graph at expiration, and the big promise that all these profits are going to be so nice, and the risk today is your T plus zero line. And if you're thinking about that T plus zero line, you're on the right path, right? So we can look at, right? So the T plus zero, the shape of this T plus zero for this trade, and let's look at the T plus zero of the bear trap trade that I put on last week. Right, while this trade is at a drawdown, forget about that. Right, that's not what we're looking at. And maybe we could look at this trade just to make it a little bit easier to see. But you can see that the T plus zero, right, it's kind of flattening out on the upside, but it's starting to really ramp up on the downside. Right, so that's the risk profile. We make some money, forget about how much. We make a profit to the upside and we have no risk, which is nice. But we'll make a profit on the upside. But if things start to roll over, things could go from bad to really bad. Now, if we look at the risk graph of this other, whatever we are going to call it, right? It's kind of similar, right? We'll make a profit, right? The T plus zero will flatten out on the upside. And on the downside, if the market just rolls over, right, things will go from bad to worse. So as far as immediate risk in this trade, they're very similar. We have another moving part here, though, is that if the market just goes into, whatever you want to call it mode, and it just rips higher, right? We can't fall asleep here, because while we are collecting a $9 credit, right? If the price moves outside of the structure or outside of the profit tent, there is a potential for a loss at expiration to the upside. So we may have to think about, right, recovering this small debit, which would be somewhere around $100. Right? We have a risk of potentially losing $100 at expiration if this trade goes unmanaged to the upside. And the only really way to do it, right, if we have a 6900, 6910, and maybe we'll roll 6910 down 5, or we'll roll 6900 to 6905, which will be a net credit. Right, so maybe we'll get a chance to recover that $100 risk to the upside, right? But the risk to the upside isn't as great. Are we concerned that the market is going to ramp and go up, 5, 6, 10% to the upside over the next 42 days? There's really no evidence that that's going to happen. Yes, the options are currently pricing in a move up to about 7,040 or so, and down to about 62.35 to the downside over the next 42 days. But if we stay inside of what is currently being priced in already at a slightly elevated volatility levels, there's a pretty good chance that we may catch the price somewhere inside of this profit zone. Do we hold it until expiration? I don't know. It all depends. Where are we with 21 days to go, right? Something like this. If we're still somewhere up here, or maybe if we're, still trading in the range and volatility falls 4 or 5 points, and this trade is showing a really good profitable P&L, right? We kind of have to think to ourselves, there's no right and wrong. Again, I'm not here to tell you what, to do or what not to do, but you kind of want to think to yourself, do I want to hold for the other 21 days? Or do I want to unlock this margin and go look for another trade? Depending on what you got going on at the time, maybe the right move is to get out. Maybe you only want to capture 70, 80, or 90% of what's available inside of this tent and get out. But you got to define your profit target, right? You got to think about what you want. And again, you have to consider, if we get there with 21 days, what if we, get there with only 8 days? And that's after potentially threatening to the upside, make some kind of an adjustment to recover the initial upside risk. And then the price starts to roll back into the, right? There's a lot of ifs, but we kind of want to think ahead of time. I don't think that this is something that needs to be, thought about, 35 days ahead of time, but we want to have a general idea, right, about what we're going to do, because it's not a great risk that the price is going to revert back into the structure. The bigger risk is that if you have 8 days to go and we're kind of sitting around the upside break even, the question is, do we want to lock in a profit and move on, potentially risking it? Or do we want to see if we can pull deeper into this profit zone and make a little bit more money? And that's a great problem to have, right? The biggest concern for this trade is if we're putting this trade on, right, and we can look at the Greeks. Right now, we have a small positive delta to start. So it is a bullish trade, even though it could turn slightly bearish as we start to run up. You can see that on the way up, if we cross the upside break even, my delta is going to start to turn negative. But to start, this is a slightly bullish trade that has a positive theta decay, and it is short implied volatility, which means that if you think volatility is going to contract, this would be a good trade to put on. Right? And think about implied volatility contraction. Why would implied volatility contract? Why does volatility go down? For the opposite reason why volatility goes up. When the market starts to move outside of the ranges that are currently being priced in, implied volatility is going to expand. Right? The range is going to volatility and the range is going to increase. If the market starts to move with less volatility with what the market is pricing in, then implied volatility is going to start to contract, right? The market's going to start to willing to pay less for insurance against drastic market moves. Nick is saying one thing to keep in mind that T plus 0 is drawn assuming no change in volatility. If there's a big move in IV, we'll certainly change and move T plus 0 line. That is 150% true, right? We cannot blindly rely on this T plus 0 line because the software could only do so much. It'll give us a general idea about what we should expect from this trade. But yes, if you just look at the T plus 0 line, right, where it is right now, I'm going to start to move volatility up. As volatility rises, T plus 0 is going to go down. And as you can see, this darker gray area is going to start to increase because the range, implied range, is going to increase as well. So this trade is a great trade to put on if you're willing to exchange some of that fat bear trap profit for a wider profit zone, introduce a little bit of an upside risk that can be easily handled later on in the trade, not really taking on you're not really taking much more downside risk, because again, whether it's a bear trap, whether it's this trade, if we move down to where we're down about maybe $500, maybe $600, it's time to get out. Why? Because that $500, $600 loss is a reasonable number. If it isn't a reasonable number for you, then you find a reasonable number for you, right? And whatever that number is, make it work, right? Just don't do something silly like, oh, I could potentially make $900 inside of this structure, but I'm willing to only risk $100. You'll get stopped out like 3 times a week, right? So either size trades a little bit lower, smaller, lower, meaning number of contracts, smaller size. And we can talk further about this. You don't have to do 50 wide on the downside. What if we only kept this spread instead of 50 wide, make it 30 wide, right? 30 wide will reduce initial credit, will also reduce our margin requirement. It'll cut risk on the downside, right? So that's an exchange. Less credit, that's negative. Less risk to the downside, positive. A little more risk to the upside, negative. Right? So you get the positive on less risk to the downside, but you get the negative on a little bit more risk to the upside and a little bit less credit on the inside of the structure. And you start off with slightly short delta. So you can literally massage this trade into whatever you want it to be. You want to start off with negative delta? Well, you have to change the width of the spread. So maybe what if we wanted to not only reduce the width of the spread on the downside, but we also cut the call credit spread width from 10 to 5 points wide. Well, that shifted things a bit as well. We go back to a net positive delta to start, right? We have very small upside risk, and we have less, but less if we were comparing this to the original 50 wide on the downside. We have less margin requirements, so this could be an easy trade to do in a smaller account as well. Right, so many different ways to slice this. You got to figure out, you could move things around. You don't want to do a 50 wide or 30 wide at 62.50. You want to get closer to at the money. You'll probably get more credit inside the structure, but your range is going to be a little bit narrower. You want to be a little bit safer and you're willing to give up some of the potential profit inside the structure, then you move your put credit spread farther out of the money and maybe make it a little bit narrower. But the beautiful thing about this is that this trade, you can literally turn this into whatever risk graph you want it to be, right? To make it fit your trading needs and your risk profile. All right, so this is just an idea. Again, I'm going to say this that, and I don't mean to continue to repeat myself about this, but is right now an ideal time to do it? Maybe or maybe not, because again, if the ranges are expanding, I don't think we're gaining anything. If implied volatility is going to continue to increase, we're not really gaining anything because implied volatility will replace any time decay or profit from the theta component, right? If there is evidence that the range is decreasing and volatility is actually contracting, I think this is a very fine trade to put on. And if you wanted to kind of take a shot at a slightly bullish, neutral to slightly bullish trade, it's not a terrible trade. Just have to understand that if the market starts to drift higher, no problem. You got to think about, what are you going to do on the upside if we move in excess of, 3%? If the market starts to roll over, this is no different than having, the bear trap trade on. You have to know where your stop is, and you just kind of have to, let it play out and see what happens. Right, so it's not a secret sauce. It's not some holy grail. This is definitely not something that I have invented. I'm pretty sure there are a billion other gurus out there that might have claimed this trade already. I have no idea who they are or why they're doing it, but I kind of try to let you in on what I'm thinking about this, how I'm thinking about this, the way I view risk in this structure. If you agree, great. If you don't agree, great. We can talk about this. You can, make different suggestions, comments, or whatever, and that makes it a great conversation. And, my goal is to make you guys think a little bit, right? If you wanted to do something similar, except you want to play a failed upside trend, and now you're expecting the market to trend downwards, okay, great. How about this? Why don't you set up something like this? Right, maybe it's a little too wide. something like this, right? This is just the opposite of what we were talking about, except, we were looking for little risk to the upside, all of the risk to the downside. This is just a mirror image of the same or similar trade, right? Where all the risk or most of the risk is on the upside here. You start off with negative delta. If the market is going to move lower, sure, being short Vega on the way down isn't ideal, right? There are probably other ways you can structure risk. But the point is that you can turn this trade into whatever you want it to be. You just want to understand where you're going, and then we can put our minds together and try to figure out the best or the way to get there with the least amount of problems. I hope this makes sense, guys. And if it doesn't, it's okay. We're here to talk about this. You're here to ask questions, and I'm here to try to answer your questions. So if you have any questions, you can let me know. You can post them in the chat here on Zoom. I think this is all I have. If you guys want to look at something else, let's have a look at whatever you want to look at. If not, I'm going to let you guys go, and you could enjoy the weekend. Hopefully, spend some time with your family, get away from the markets, and the markets are going to be here next week. So I see people are dipping out. Let's have a look. I'm going to spend the next 2 minutes just to talk about the VXX trade and where it is. The market is trying to stay green, and volatility is slightly lower, but not by a whole lot. And the VXX trade. So I added the second tranche to this trade, and hopefully, right, as volatility in VXX is increasing, even though you see that, VXX right now is near the lows of the day, and it's lower than it was yesterday. So you would think that naturally, right, this trade should be either profitable or a little bit more profitable, but volatility in VXX is still higher, and that's kind of pressing that T+0 line. You can see that if I start to move volatility up, it's shifting T+0, but not a lot because there's only a -2.5 Vega in this trade. So there's not a whole lot of exposure to volatility, but we know that if the market tanks and volatility explodes, this VXX can do wild things, right? This was back in April where this thing went from 45 to 90, doubled. So can it go from 40 to 80 this time around? We'll see, right? But the idea is we add to this position on the way up, and the position is, look, I'm going to sell an at-the-money call, and I'm going to, whatever I'm collecting, like if I was to set up a trade today, right, with VXX trading at 38.64, so maybe it's a 38 strike, maybe it's a 39 strike. Doesn't really make a difference. Maybe it's a 39 strike, right? So I'm collecting about $15.45, and I'm gonna look at the puts, right? At 39 put is going for $15. So if I was to do a synthetic short at 39, I'm actually possibly collecting a small credit. So short a 39 call, you have to be very careful with shorting calls because the risk to the upside is unlimited. We assume that this underlying is going to drift and potentially go to zero, but technically it could go up into infinity. And if you're short calls, upside is unlimited, right? But looking at a 39 risk reversal or a synthetic short, right? Short a 39 call, long a 39 put, actually pays a 45-cent credit, which pushes our upside break even to 39 plus whatever credit we collect. So 39.45. Right, and this would be a bet. We get about 100 short deltas in VXX. That's our exposure, which means we make about $100 for every 1 point move to the downside, and we lose about $100 for every 1 point move to the upside in VXX. Right, and again, you can use whatever you want to use to try to time the markets. Right, we see these, I don't know what you want to call these, flare-ups. Every now and then, volatility spikes. VIX future contracts go in backwardation. VXX has a couple of days in the sun, and then it continues drifting lower. It spikes, and it continues to drift lower. It kind of flattened out recently. Right now, it's spiking to about a 40 level. Is there more upside? I don't know. If there is, you kind of want to plan for additional tranches on the way up. Put yourself in the position, improve your cost basis, push your upside break even farther out. And then when and if the price reverts back and continues in this downtrend, and again, this is not a right chart to look at. If you want to look at a chart of VXX longer term, use whatever you use for charting, and you will see that over long periods of time, this thing is just grinding lower, and it's probably going much, much lower. It's not going to be without some of these spikes. So that's why you have to be prepared to potentially add to the position on these spikes. And then when the move lower continues, we get out of those positions that we put on during volatility spikes. And again, this is in no way, shape, or form a financial advice. This is not a tax advice, but you definitely want to think about, right? This trade is 455 days away, so it has some time to go. But if you're going to trade around a core position, especially if your holding periods are going to be less than 1 year, assuming that your broker is on default, first in, first out, right? If you put on position at 38, you added to it at 55, and then it went back to 38, and you're getting out thinking that you're locking in a profit on that 55. No, you're going to be getting out of that initial position at 38. So you kind of want to think about for tax purposes, right? If you're closing out, what is that going to do, as far as tax liability goes? If it sits well, if you need a loss, if you don't need a loss, if you want to realize a profit, whatever the case may be, you want to think about that, and then you can pick up the phone, call your broker, and give them instructions. Is it first in, first out? Is it last in, last out? Is it last in, first out? Whatever the case may be, but you got to think about that and consider your own individual situation. All right. With that being said, guys, I'm going to run. Have a good weekend. Always, always, always remember, you have to take care of the risk first. The profits, they're going to take care of themselves. You take care of you. Have a good weekend. Until next week, guys. Take care, everybody. Bye-bye.